Good evening, everybody. Thank you for being here. Really appreciate it. Man, look at the chat already. I'm not late. There's already so many messages. Chels, what's going on? Lena, what's going on? PB, what's going on? Who else is in here? I think Ray was in here. Ray, what's going on? Not late. I don't know why you would say that. Not late. So Chris should be here in a few minutes. Spoke with him earlier. So let's get the disclaimer out of the way. Please keep in mind, I am not a financial advisor. I have no idea what your situation is. Please take everything I say with a grain of salt. Please do your own due diligence. It's very important. Anyway, pause, read the disclaimer. Make sure you understand what you're investing in. Don't invest in anything just because I talk about something, just because Chris talks about something, or anybody else that shows up on my channel. Everybody is responsible for themselves, and do your own due diligence. Thank you very much. Well, we got a little bit of a rebound today. Now, everybody freaking out last week, and then we get a good print on Friday, and today did pretty good. Futures down just a tick, not really that much. So I'm excited. I'm really excited. The bulk of earnings season's out. For me, it's all about NVIDIA now. So I think that there's some very interesting things happening. One of the topics tonight is going to be PayPal, another SaaS, and then Fintech. So I gave you the link. Hold on. Chris is looking for the link. I'm sending him the link again. He'll be on in a moment. And we have another episode, Basis Points, coming out on Thursday. Oh, whoa. What's this? You got glasses, no hat. What's going on here? He just exited himself. And now he's re-entering. What is this? New look? Mic not working.
There we go.
All right.
So
you never wear glasses.
Well, these are the Meta Ray-Ban glasses. I actually wanted to show you guys. That's why I was a little bit late. Give me 1 second. Show Bluetooth. These, in my opinion, are the future of accessories.
Well, I like hearing that. Meta, baby, meta.
Yeah. So these are Amit's actually. Amit got these from, because Amit is Amit. So he got these from some friend, whatever. And he didn't find them useful. Bro, I love them. I find them useful. They're really good. Like this weekend I was at a funeral, probably the worst place to use these cameras, to be honest with you. But yeah, it was there were points where I just kind of wanted to tune out. I wanted to listen to something else because there's like a lot of like stuff where you just have to just wait and stuff. So I was listening to like a nice podcast. I was listening to things and yeah, and then I was driving with the wife, and my wife was talking to my cousin because we had to pick her up from the airport and everything else. And I was just like, put on my glasses, listening to my thing. It was awesome, dude. I loved it.
So what are the features that you really like about it, and how is the quality when you record on it?
Dude, the quality is amazing. Did you see the thing I posted on X? Then when we went to lunch that day at Patsy's? No. It was I posted it when we went to Patsy's.
Oh, did you?
Yeah. So if you go
I didn't even realize that was with the glasses. I did see that. Yes.
How crazy was that, right?
Yeah.
Yeah, the quality is amazing. The battery life surprisingly was really good too. So, I mean, I find these to be pretty good. The only thing is these are the ones that don't have like a visual yet, but I think that's like the next generation or two it's going to happen. Like they already have the ones with the camera include like the screen in there, but like the frames are kind of big, right? They're kind of bulky. Um but I think these, dude, the only thing I worry about when it comes to Meta and these glasses is that it's very likely that if they are a success, we're probably going to see Google and Amazon, I mean, and Microsoft create the same exact thing. I mean, not Microsoft, Google and Apple.
Apple.
And now it's all of a sudden you're competing against them. So Meta's really got to do thank you, honey. Meta's really got to do a good job of getting this stuff together. Now, the one thing I am wondering is because I have my iPad, right? So there are a lot of times where I'm like doing some certain analysis on my iPad, and like I wish I had like a second thing to just have, like basically have a information here and there at the same time, where this is actually reading here and actually telling me what I'm looking at. And well, I mean, it does that too. Like right now, if I can actually say, hey, Meta, what am I looking at? And it'll actually like look and it'll tell me. It like uses AI to figure that out. I don't know how I can show it to you guys because it's actually really cool. Yeah. So let me take these off real quick. There we go. Wow. Let me put on my regular headphones. Give me 1 second, Steve.
Yeah, take your time.
Cool.
And I love the fact that you are so bullish on the Meta glasses. That makes me so happy.
I mean, I see the value in these things, dude. Some other people may not, but I see it.
I think there's going to be a lot of value in sports, in recreational activities, family events. Like there's huge amount. I mean, I could see snowboarding, skiing, that type of stuff that's becoming really big.
Yeah. Oh yeah. So I think Meta is doing its best to try to diversify away from just the Apple ecosystem and everything else, but it's gonna, we'll see what happens. All right, let me just get my audio good and sound output is headphones. Okay, cool. Say something so I can get.
I'm excited that Chris is excited about Meta more than he already was because that's going to make me a lot of money. And I'm excited. I love it.
There you go. Now my headphones are having difficulty connecting because
God.
Hold on. Okay.
And just so everybody's aware, I did book the hotel. I will officially be in LA. I am getting on a plane. First time in a long time.
But you're an illegal. How is that possible?
Let's just say that the United States government's going to let me get on a plane, Chris.
There you go. Source, and we'll take reconnection. Jesus, iPhone and PC. Yes.
Yeah, the good thing about
this is the one downside to Bluetooth. Like, I have so many peripherals that I'm always switching in between, and so sometimes like it has a limited number of connections that you can have at any given time, right? So you kind of have to always switch back and forth. I wish there was like an easy way to do it, but you don't. So,
and sometimes it kicks you up because it'll pick up on another device.
Yeah, like it was connected to my iPad. So like every time my iPad would get an alert on something, it would switch to that, and then I would lose, like I couldn't hear you, right? So yeah. Okay. So what did you want to talk about today? I wanted to specifically talk about SaaS going from growth to value and how we can actually make money on SaaS now.
Yeah, that's good. I want to talk PayPal for 5 minutes, and then we can just spend the majority of the time on SaaS. So I really went through the numbers. I went through them last night with Matt, and I went through them today again. And I'm debating at what number am I going to be a vulture. This could go down further, but I think it's going to be really hard to go down further. When I go through the numbers, and I know all the hardships, and I get it, but I think that an activist has to come in at this point. There's too much value to be. I mean, shit. If people came in as an activist on Macy's because they own the air rights above the Herald Square building, and Macy's is nowhere near the business that PayPal is, I just think somebody's going to come in and make some changes. They're going to either one, sell off the parts, and could be something where some of the parts is worth more than the valuation. At a $37 billion company generating $6 billion in free cash flow, there's a lot of things that can happen. And
I mean,
I just think it's very cheap here.
To me, it's an easy play, to be honest with you. Let me see if I can do this. I'm trying to learn how to use my iPad to present. Does that like, because the thing is, like, there's a lot of
yeah, I mean, there's presenter mode on it, but I think it's only Mac to Mac. I don't know that you can do it on StreamYard.
Well, this is how I think I'm gonna do it. Like, I'm trying to log into StreamYard right now using my
Mac. Yeah, I can pull it up on another screen.
Yeah. So join with that. Chris iPad. Okay. Right. So there we go.
It says device not connected though. Like, it's showing up, but I can't bring it to screen.
Okay. No, I will.
Oh, Chris, it says they will need to connect their mic and camera. There you go.
Hold on. Before you do that, mute back this.
So while Chris is figuring that out, I'm muting both of his things.
See, this is the thing with the iPad. I want to share my screen, but how do I share my screen on here? Because
what do you have on there?
Say that again.
What do you have on there that you want to share?
No, oh, sorry. That's that.
Chris, I'm muting you because when you have both of those on, it is the worst reverb.
This is
all right. While Chris tries to figure that out, I'm going to continue to talk about PayPal. So let me bring up the numbers for everybody real quick. This is getting cheap. I'm not saying anybody should do this, okay? It's up 1.8% today for a reason, I think. Market cap, $37.2 billion. It looks like it wants to bounce. It looks like it wants to form a bottom here. Now, looking at the numbers, once again, year-over-year growth in revenue every single year. It has never reversed on a year-over-year basis. Still very profitable. And looking at the balance sheet, $10.42 billion in cash on hand. They have another, how much do they have? $4.3 billion in long-term investments with $9.98 billion in long-term debt. They have more short-term cash on hand than debt. It's an unlevered company. So even if they paid the entire debt load off, they still have over $4 billion in liquidity without tapping the debt markets. This is a company that is doing $5.6 billion in free cash flow this year. Expected to do $6 billion in free cash flow next year, or 2026. So when I think about this, and then where the analysts have it, pretty much no EPS growth this year. I'm not really concerned about 27 because I have no idea what they're going to do 27. I don't even know if they're going to be public anymore. But they're still expected to grow revenue by just over 3% in 2026. So, I mean, this is trading at just over 6 times free cash flow. I think there's going to be vultures circling on this company, and I think that there is going to be a play to be made. I just don't know what the time frame is. And I think I'd rather see it bounce to 43 or 44 before I felt good about starting a position, because this could very easily go into the 30s. So that's where I'm at on this. But I've seen activists come in on worse companies or companies that have not as strong financials. And an activist has a lot of options on what they can do. They can stop the buybacks, they can go after acquisitions. There's certainly more than enough free cash flow and liquidity on the balance sheet to acquire smaller companies. There's a lot of things that they can do. So, Chris, you figure out what you want to do?
I don't have. Well,
did you hear what I said about PayPal?
Yeah. I heard. Okay, so
I mean, you're in it, right?
Yeah. No, I'm in it. I have some spreads. I see the value in it. I also looked up the profile of the new CEO, what kind of plans he's probably going to have. But there's a lot of value in PayPal right now. If you just look at the yield on their buybacks, it's almost 15-20%. So right now, PayPal is definitely like a value company. Like it's way beyond value at $55-$60. When a lot of the other guys were like talking up PayPal, like Alex Chris is going to do that. Alex Chris is going to do this. I was like, okay, I was in like the show me stage. And of course, they didn't perform. So now PayPal is in deep value territory. So this is where I kind of get interested, because when you go super deep value, there's not a lot of downside relative to the upside potential. And like the asymmetric returns, especially if you know how to use the options market and you know how to do the right spreads on it, you can basically de-risk the position where it just has to return back to the mean to get you to break even. And then any outperformance after that gets you a significant return. So I'm already up 10% on the position. And I literally bought it not too long ago. So, I think I could do pretty well on this position. So, yeah. And the thing is fundamentally they do have some catalysts that are coming online right now that a lot of people are not necessarily giving them credit for. Like their growth in Venmo is actually starting to reaccelerate a little bit. Their branded checkout is having some difficulties, but like I said, they're still generating significant amount of cash flow. They're going to be deploying most of that cash flow, even from their guidance, back to share buybacks. I mean, that's what they guided for, right? So let me just bring it up really quickly.
$6 billion in buybacks. Their free cash flow.
At $36 billion, you buy back $6 billion. That's what, like 18% of the float?
Around there, yeah.
Which is kind of insane if you think about it. And the thing is, they're not in a place where they can't support it. Their net leverage is also very low, right? So their net debt to EBITDA is low. So they could actually even take on leverage to buy.
Well, there's really no leverage because they have more cash on hand than long-term debt. I mean, they're a cash-rich company.
Yeah. So, yeah,
it's one of those companies. There's just too much value there, where I do think an activist is coming in, because this is the quintessential company that activists should go after. Yeah. Cash rich, huge free cash flow, and future revenue growth. Even though it's 3%, there's still revenue growth expected this year. This is not a dying company, and it's got the worst stigma on it. And I think people are overlooking this.
Yeah, and this is why, like, when Roy got out of his position, Roy has been a PayPal diehard bull, right? He's tried to bring as much light into this company as possible. And when he capitulated, that sort of signaled to me like, hey, even the most like stringent bulls are now capitulating to this. And usually for me, that's a pretty good sign, right? Like, and there's a lot of other investors that kind of just gave up on it. And so that leads me to believe that, you know what, I think we're somewhere at least close to the bottom. You know, and I don't blame Roy, by the way. I think it's frustrating to hold on to a position for 2.5, 3 years. It's constantly like going through its transformations, and you kind of have to keep justifying things. But I think the sell-off was overdone. And I think right now, especially from a de-risking standpoint, the stock is pretty much de-risked. I think this thing easily gets about $80 in the next couple of years, just based on math and fundamentals, right?
I mean, let's call a spade a spade. This trades for a lower PE than every tobacco company in the market, I believe.
Yeah. Yeah.
The only one, British American, yeah, every tobacco company. This is a lower valuation than British American Tobacco, Altria Group, and Philip Morris. So are we really going to say that tobacco companies should trade at higher multiples than PayPal? Because that's what the market's saying right now. It's I'm not saying this company should be 120, 150. I don't think it should be 40.
I agree. I
agree with you 100%. The sell-off is overdone. Is it a hated company? Yes. But is there value there to be unlocked?
Yeah.
I'd be shocked. And I'm not saying that can't happen, because it can, but I'd be shocked to see this in the low 30s. Because if this goes in the low 30s, you're talking about close to a 30 billion market cap. I mean, that's trade. That would be trading at 5 times free cash flow.
Let's just look at their.
You buy at that.
Yeah, let's just look at their investor deck real quick. So here are some highlights, because their transformation was starting to work. It just wasn't like what they were like everyone was expecting, right? So it's not like PayPal was dying. It's just that they were going through its transformation. They did lose out a little bit on Venmo because they were being a little too conservative, right? But if you look at this, they're still growing. It's not like they're not growing. Their core, their biggest, what is it right here? So Venmo highlights, they had 20% growth in Venmo, which is amazing. So Venmo, like 2-3 years ago, wasn't even that monetizable. Now they actually have some monetization there. So they've got total transaction volumes using their global debit. It was 35 billion. That's a 60% growth rate there. They've got a lot of users using debit cards over at UK, Germany. I mean, you know, there's value here. There is definite value
to be unlocked. There's no question about that.
They've got recent partnerships with Microsoft and OpenAI. You know, like I said, I wouldn't even be surprised if and that was the other thing too, that they have a couple of other platforms that they're going to be doing something. Have you heard of Fastlane? Do you know what that is? So they have Fastlane.
I can't explain it, but I know what it is because Roy has explained it at least 3 times to me.
You know, I want to get Roy back into this. I kind of want to tell him, be like, look, brother, I think you sold a little early. I think instead of selling out of the position, you should take some of that in about 30 days, wait for your tax loss harvesting period, right? Take some of that money and buy a very, very long dated spread on this thing. Because I have a very long dated spread on this. Because I know there's 3 years worth of growth, 3 years worth of buybacks, 3 years worth of EPS growth. In which case now, even if this thing reverses to somewhat of a mean, I think Roy could get all of his money back and then some. Do you have Roy's number?
I was actually debating calling him and telling him to come on.
Call him.
All right, hold on.
And I'll you know what? And because everyone is here, I'll even share the spread that I have right now. And I'll go through the math with you guys so that this way everyone kind of somewhat understands what it is. See, this is the part that sucks. I can't share my thing with you guys. Like, I wish I could share it from my iPad so I can show you, but. Oh, is it? Oh, Roy probably going to come on. Come on, Roy. Get on here, buddy. Can we talk about Snap? A lot about no, Mikey. I will never ever touch Snap. Okay, do not trust Snap at all. That company is run by executives, for executives, and for employees, not for shareholders. Okay. Not for, no, I would not touch Snap with a 10-foot pole, man. I'm sorry, dude. And then you got Zuckerberg, who is not afraid of just cloning everything successful that Snap does and integrating into Instagram. Dude, way too much risk from someone who's got way more capital. The executives don't give a crap about shareholders. Not worth it. Sorry. That's just how I feel about Snapchat. Block is the same exact way. Dorsey runs these companies for the benefit of his employees, not for the benefit of shareholders. That's why if you look at Block, it sucked. You look at Twitter. Twitter, before Elon took over, sucked. The only reason why Twitter shareholders made any money is because Elon got caught saying some shit, and then the SEC made him buy the company. I'm stuck.
All right, he'll be on in a minute.
Okay, yeah. Yeah, because I think, like I said, I have nothing against Roy. I just think he got frustrated more than anything. And so I've had that happen to me too. Like my rational brain went out the door when I just saw one bad thing happen. And then all of a sudden it was like, yeah, you know what? I'm going to get out of this position. And I don't look back. And I look back like 2 years later, I'm like, God damn it. Why did I get out of this thing? Like I already took I already had the L. Why the hell couldn't I get it? And the thesis was all correct. So,
keep going through the deck. Go to the guidance.
Okay. So right here. So FX growth. So Venmo right here, branded experience, percentage of totals 33. This percentage is what their total thing is coming from. So their total transaction volume grew by 7%, and in the fourth quarter by 6%. So this is not a growth company. Okay, so transaction volumes are still growing. They're just not doing.
Go down. I haven't gone through the deck yet. Did take rate go down?
I think it did, because they are trying to be a little bit more mindful, because there is competition out there. Okay. Like
guidance.
Yeah.
So 3% growth on operating expenses, $6 billion free cash flow. I mean, there's so much value here.
Well, Steven, see, this is the part that I think they conned shareholders. You see that number right there, the low single digit FY $5. They lied. That's not what it is. They lied out of their, well, technically they didn't lie, but what they did is they undercut their own, they kitchen sink themselves, basically. You know why I say they kitchen sink themselves?
So they can come back and throw out a beat?
Exactly. And throughout the rest of the year, they're going to throw beats. But here's what they're going to do with the rest of the year. Because they depress their own expectations like this, think about it this way. What was their earnings last year on this thing?
Before we go to the earnings, I think Chris is right, only because how the hell do you have a mid-single digit decline when you buy back 18% of the goddamn shares?
Exactly.
How?
Exactly. That's the part that didn't make sense.
Chris and I have disagreed on this for a while about, are the buybacks providing value? They haven't so far, but that doesn't mean they won't this year, because at an 18% freaking yield, I mean, Chris could be right here. I agree.
Yeah. I'm telling you right now, and people looked at this number, they freaked out saying, oh, there's flat year-over-year growth. I'm like, dude, if you're buying back 20%, almost nearly 20% of your outstanding shares, how do you not have EPS that grows at least 10 to 12%? At least, even let's say the business starts to go the other way. Now, could there be some restructuring charges and all this other shit that they throw in there? But that's not going to be a problem, right? Because they'll end just adjust it anyway. So I think these guys, they kitchen sink themselves, gave the new CEO this wiggle room to come in and just launch this massive share buybacks. And like I said, they have barely any debt in terms of like net debt to cash that they have on hand. They probably need it for working capital. They could lever up probably another 10 billion over the next 3 years, buy back even more. I mean, you could see the float of this company get dropped by 30, 40% easily in the next couple of years. in which case your EPS is going to jump to like $9, $10.
Oh, he's here. He is here. Never fear. Roy is here.
Roy, welcome back to the PayPal.
You guys can hear me okay?
Yes, we can.
Come back. We need you back in the PayPal bag holder community, brother. You know,
I knew it was going to be about PayPal.
Chris
It has
is
to
super
be.
forward.
it has to be.
And I got to tell you, I'm thinking about becoming a vulture myself.
Listen, we need to pick at this carcass, brother. That's what I'm telling you. This dead hippo in the middle of the Sahara is there, and us lions. I mean, lions eat dead shit too. We are here to just pick through the bones of this company, but there's
Chris,
real
I think
value
you're
here.
right. Think about this. They did $5.46 in EPS this year. They're saying 531 on non-GAAP and 541 on GAAP. I agree. How the hell does that even happen when you buy back 18% of the shares?
It doesn't make sense. Now, here's the other thing that maybe, Roy, and because we're good friends, I will actually tell you about this strategy. There is a very, very mispriced options position on this company. Look at this thing. So this is the position that I have on it. Okay. I don't know if you can see it. Is it backwards? Is it coming off?
No,
backwards?
we can see it.
I can see it. It's fine.
Okay. Basically, what I did was I bought the $50 calls on PayPal and sold the $90 calls on PayPal for December of 2028. Okay. And I only cost me $5.50, $5.60. Okay. So the spread between the two positions is almost $40. Okay. $40 spread that I was able to buy for $5.50. That is a 700 something percent return. If it goes to 90, even if my break even on this is $55. Now, here's the thing, you know how much cash flow these guys generate. They're going to be generating this kind of cash flow for the next 2 years. They do all these crazy share buybacks. Their float is going to go down. Earnings are probably going to jump up to $8, $9, maybe even $10 by 2028, right? So even at a conservative bank PE, okay, like banking related PE of between 9 and 10, you're still looking at an $80 to $90 in share price. Okay. This is by the way, this is not like, hey, just buy this tomorrow morning. It's going to go to $80. But dude, I think this thing easily gets to 80, $90 by the end of 2028. Right. That's 3 years from now. 3 years. And you're getting a 700 return.
And it could be.
Right. So the stock
it could be. There's
sorry.
a couple of things though. A couple of things though. Like one is you're ultimately having a hardware guy in charge of a software company. That maybe that's not the best thing. This guy is known for being a cost cutter, but if you look at the proposed cuts related and compare that to, it was, I think the 10K, or it might have been one of the more recent 10Qs. It was just double the amount of layoffs that they planned anyway. So it's not a huge deal on that. My concern is, okay, they're guiding for decline somehow despite buyback. So either they're like doing the most colossal sandbagging ever, but we don't know because Alex Chris isn't there, or like they're telling us the truth. They're like, hey, maybe we won't be in quite decline, but like zero growth despite all the buybacks, in which case there's something very wrong. Also on this, like the one thing with PayPal is there is a chance like it could have phenomenal upside from here if basically they leave most of Alex Chris's vision and what he's initiated intact. If they do that, like advertising should be a layup. PayPal World could be good. Fastlane, we'll see. Yep. But they may not do that. Like, I don't know. And with the new guy in charge, there's just so much that we don't know. Jamie Miller ran the call, which means she was pretty tight-lipped about most of the stuff that analysts were asking. Actually, she was flat out dodging questions once in a while. So, there's risk here. There's risk.
I did a deep dive on this guy. Okay, he is the guy that they put in charge, the CEO. This guy is a cut, buy back a ton of share CEO. Okay, you look at HP, what he did over there with separating HP Enterprise and HPQ to unlock shareholder value. This is the same exact playbook he's going to be running at PayPal. I'm telling you right now, the share and the way that you can tell is look at those share buybacks. if they really thought that the business was deteriorating, they would not be guiding for that many share buybacks of $6 billion. They know what they're trying to do here. They're trying to sandbag themselves. And right now, because they don't have any debt, Roy, they're going to be buying back a crap ton of shares at $40 a share. I would be surprised if the next 2 quarters they didn't blow through that $6 billion repurchase thing and they re-upped it in the third and fourth quarter to raise it again. No, I think they will. I think they will. If your company is trading at a 6 EV to EBITDA right now, do you know how value accretive that is to shareholders? It's insane, dude. Any CFO, CEO worth their grain of salt right now, trying to generate value for shareholders would be doing that right now. I'm telling you, and even if they don't do it, that entire board is going to get steamrolled. That entire board is going to get steamrolled by activist investors.
That board is full of very conservative, in some cases, dinosaurs. No offense to the people that are on board.
I agree. I'm agreeing with you.
There's been opportunities already when it looked like PayPal was a better opportunity to buy back more aggressively. With one person gone, I don't think that's going to change at all. I think that's just in the blood of PayPal. Sorry if my internet's going out. I don't know what's going on.
No, that's fine. No, I think this is an Alex Chris saying, look, we need to think about this as a long-term transformation. And I think you're right about the shareholder board being more like dinosaurs. But what do dinosaurs do when the companies are declining? Like not declining, but like returning to value. They go right back into, they don't go extinct. They go back into doing what they know best, which is, hey, let's just buy back a crap ton of our shares. I mean, look at Apple. Do you think Tim Cook is the innovator in chief at Apple? Like Apple's been languishing for the last 5 years in terms of total revenue growth. What is he relying on? A crap ton of share buybacks. And that's why Apple's value is there. Share buybacks, at least at a 6 EV to EBITDA, is an immense amount of value that you're going to get by buying back shares.
I want to show you guys something. So I just modeled this out. Let me remove that. I gotta tell you, I really think I'm becoming a vulture tomorrow. Maybe not tomorrow, I shouldn't say that, but soon. I mean, all right. So these are the trailing 12-month numbers. Gross profit margin 41.5%, operating margin 18.7%, EBITDA margin 20%. Free cash flow, net income all over 15%. Now, price to EBITDA, 5.7 times. I don't know a single company that is trading at 5.7 times off the top of my head on EBITDA. I mean, this is absolutely insane that on every profitability metrics and then a cash from operations metric, PayPal is not trading at more than 8 times anything. This is either a company that the market thinks is going to zero or one of the greatest value plays of all time. I mean, Chris, have you ever look at this? Look at these metrics right here. Have you ever seen something traded this low?
No, not for a business like this one.
Like this is not a company that's going from 6 to 3 billion in freaking free cash flow. Yeah. And I think Chris is right. I think they're gonna kitchen sink it. I think they're sandbagging on purpose, knowing that if the stock price stays here, this is something that they can take advantage of and throw $2 billion to buybacks this quarter. Throw another $2 billion next quarter.
I'm telling you, they are going to be buying back a crap ton of shares, dude.
I mean, in all seriousness, if I was their CEO, which I'm not, but neither is Alex Chris anymore. I made that joke before. It was pretty funny. But I would take $5 billion in cash and I would deploy it to buybacks tomorrow and still throw all $6 billion behind it on the free cash flow. Buy back 30% of the company this year. Watch that EPS jump off a freaking map.
Yeah.
Because there is
a value play.
They are in no risk on debt because they got over $10 billion in on-hand cash. Take $5 billion, throw it toward buybacks in addition to the 6, and you still have roughly a 1-to-1 ratio with their long-term debt, the remaining cash in the short term and long-term investments. Like, An activist is going to come in at some point. I just don't see how an activist doesn't.
That's the other thing too. Anytime you have this kind of cash coming in, dude, every single board member can get proxied. Okay. Their entire incentive at this point is to buy back as many shares and not get proxied. And look at this. They're even, can you share my screen real quick?
Yes.
So,
but even though they're not, and I agree, maybe they're not innovating, but just because they're not innovating does not mean that they're not growing. They're still growing year over year. This is not a company in decline.
So let me just hide this thing and this thing. So you can see like the move down in share prices right now. So it's like 968 million shares outstanding. If you took, let's say every quarter for the next, I don't know, 6 quarters, you did like $1.5 billion, right? Let's say $1.5 billion to do share buybacks, and you model this out. Steven.
I know.
It's insane what their share price would end up being. You know, it's one thing if their cash flows were going towards like paying down debt, but they have barely any debt in terms of like net debt. You know, they have debt, but it's not like it's almost like saying I have $10 in debt, but I have like $15 in cash. Yeah,
the debt doesn't even matter because it's only costing them $440 million a year in interest expenses. Yeah. That's nothing for them.
Yeah.
It's absolutely nothing for them.
Yeah, man. I definitely see this thing like they're going to buy back a crap ton of shares. They'll put a floor price on this thing. And here's the other thing too. The lower it stays for a longer period of time, the more it means that their EPS will grow on the back end because that just gives them more time to keep buying back shares.
You know what, Chris? One of the people in the community just made a very good point.
Yeah.
Welcome. Verizon.
Yep.
We were the only two boneheads talking up Verizon, going through the numbers, and freaking, this is another Verizon without the dividend.
I did the same exact thing with Verizon. Super low beta. Look at the return on that thing. And look at when I opened it. You tell me someone that's got that kind of return. See? 125% return on a 10% move. Congratulations. That's how you work with options. And by the way, Verizon did the same thing. What did they do when Dan Schulman came in? $25 billion in share repurchases on top of a 7.5% dividend. And they added almost 2 million postpaid. They're guiding for 2 million postpaid users that are going to be added this year. And at the same time, AI is all overvalued, quote unquote. So people are going to be chasing yields.
I think Verizon was so done yet. Verizon still has a 6% dividend yield. People are still going to flock into it.
Steven.
Dan
Schulman does not get paid any bonus money.
55 to 75. I'm aware he's not getting paid yet. I know.
Do you know the same thing? The same comp package is out there for Enrique Lores as well. His entire comp package, like all his bonus money, all of it's tied to share price appreciation. It's not to
even like 29,000 employees. They're probably going to cut 10,000.
All the metrics that are out there for Enrique Lores are all based on share price appreciation. It's not, oh, you're going to grow TMV by this. You're going to go do that. You're going to do, no, it's straight up share price appreciation. That is his entire comp package. The guy was on the board for the last 5 years. All right. He left HP. He was the CEO of HP. He left. He actually got paid to leave HP because he sees the value in financially engineering his way into a crap ton of money. When you have that kind of incentive, I'm behind you. Let's go.
And I think it goes a step further. The profitability is there. This is not a dying carcass. This is not a cigarette butt or a cigar butt company waiting for one last puff. This is fresh meat, fresh profitability, and each share is going to represent more EPS because their buybacks are so accretive this year that this is overdone at this point. I'm talking myself into buying.
Way overdone. I'm okay with it. Where did Roy go? He didn't come back?
His network is all screwed up. He was signing on as a guest account. His wife
Gotcha.
is using the main account, and something's going on with his network.
Ah, gotcha. He needs to
I
get some
mean,
Verizon. He
all
needs to
right,
get
let's
Verizon.
all right. So let's think about this. I'll
Mhm.
bring your screen back up in a minute. So, yes, PayPal is one of the most hated stocks. I get it, but sometimes
Yes.
there's money in shit. And think about this: you would have to go back to February 2017 to pay the same damn share price.
With
February
way less shares.
February 27, February 17th. I mean, how much has the revenue grown since then? Well, let's see. So, and this is where the market doesn't make sense. This has gone from 13 billion to 33 billion, and shareholders have made nothing.
Yeah.
I wish we had enough money to become activists.
I wish I had that too, but I mean, you can't do activists on this company for sure, bro. But yeah, this one's easy. In my opinion, this one's an easy layup if you understand the math.
This could be financially engineered into a much higher share price.
Yeah, and the math,
Absolutely.
I'm trying to see if I should just like show the math on it. But okay, the EV to EBITDA on this company right now is 5.87. Okay, that's the enterprise value of this company, 5.87, which is, if you look historically, show
the
my
enterprise
screen.
value is 39 billion. Everyone, it's,
Right now show my screen so that people get an understanding. It's a very easy thing to see. So right now, this is EV to EBITDA. Okay, so if you don't know how to value companies, especially tech companies, this is one of the ways that you do it. You look at EV to EBITDA. What it does is incorporate debt into the calculation, right? Usually what happens is when you're a fast growing company, your EV to EBITDA is going to be much higher. The multiples on your EV to EBITDA, when they go lower, that typically means that, they're a lot less trusting of what you can do in the future, right? EV to EBITDA is at an all-time, well, I don't know if it's an all-time low. I'm pretty sure it's all-time low. Let's see. Because they were in growth mode over here. All-time low. Their EV to EBITDA right now is about 5.87, okay? Let's say that it stays at 5.87. It's going to stay. By the way, I don't think it's going to stay at 8, like 5.87. I think it can actually get back to about the 10s. Like, it's actually, if you look at all of its industry, what is that called? Like industry comps, right? PayPal, then you have Groupon, Fiserv is at 7.8. Fidelity, whatever they're called, is about 7.8. Adyen is about 16, right? Block is at 8.3. Let's say this thing retraces to 8. Even though Fintech right now is in like hate mode right now. Let's say this thing gets back to 8, right? 8 EV to EBITDA. If you take the EBITDA, let's say it's flat for the next 3 years, 2026, 2027, 2028, it's flat. You get what, $6.5 billion of EBITDA, right? You use the same EV to EBITDA calculation of about 8 times. So if you take a calculator, let me just bring it up real quick. Okay, so let's say 6.5 billion in EBITDA, multiply that by 8. That's a $52 billion market cap. All right, a 52 billion market cap. But here's the part that is going to shock people. If they do $6 billion in share repurchases for the next 3 years, that's $18 billion. You're looking at least 300 to 400 million shares outstanding getting bought back. Right now, the total amount of shares outstanding is what is it? Like 900? What's the
like
share?
930 or something like that.
930? Let's say they're able to buy back 40, like let's say 30% of the company. Okay. So what does that end up being? Like you'd run into what, 600 million?
920.7.
No, I get that, but I'm saying, like, let's say they took out like 30% of their float.
I mean,
right?
You're talking about like 280 million shares.
Right. So let's say you end up with 600 million shares outstanding. Okay.
Yeah.
So 52 billion. Okay. Divided by let's do 600. $86 a share. Okay. And this is at a normal fintech that's not buying back a crap ton of shares. Tell me the risk to reward is not in your favor right now.
It is. No, it absolutely is. And I've talked myself into it. I'm probably going to look at some spreads, or maybe I'll just start buying shares. I don't know, but PayPal is going to end up back in the portfolio, I have a feeling, this week. All right.
Someone said, don't forget to factor in 1.2 billion in SBC, although that's probably in decline, but their SBC is all linked to share price appreciation. So I wouldn't worry about that. Their net is going down.
That's the last thing you worry about.
Yeah.
The last thing you worry about. All right, let's move on to SaaS, rotation from growth to value, Chris. I think you and I have a lot to say. Why don't you go first on this?
So one of the things is SaaS, which is software as a service.
Am I showing this?
Yeah. Give me one second.
I'm going to remove it until you log in.
Yeah.
Have you bought anything in SaaS in the past couple of weeks?
I have not.
Okay.
I have not, but I'm considering it.
I have.
Okay. Let's see. 1 second. Okay. You can share this now. So one of the things that people keep talking about is like how SaaS, the valuations are at all-time lows, right? So just that calculation that we did like before, well, we did EV to EBITDA. This is actually PE, right? So price to earnings. Okay.
Yep.
If you see here, price to earnings for SaaS is trading at the lowest level in literally last 7 years. So a lot of people are jumping in and saying, oh my God, this is the greatest time to buy. And to some degree, I am completely in agreement with them that there are opportunities out there among the SaaS names. But if you look at SaaS in general has been slowing down significantly. They've gone from 36% growth rate in 2015 now to only about 11 to 12. So you have to really be conscious of which companies you're looking at and what their growth rate is. And then on top of it, you have to layer on a multiple contraction of at least 5 PE because of the risk of AI destroying their moat. Not every SaaS company is going to have their moat destroyed, but there are some that are very thin products that someone could at least create an alternative that would reduce down their pricing pressure going forward. So every year, a lot of these SaaS companies, what they do is they just raise the prices. Oh yeah, guess what? Our like Adobe is notorious. And I don't know if people here in the comment section, if you want to comment, if you've worked with Adobe in the past, these guys have been animals when it comes to raising prices on customers because they know that they got you. There's no alternative. Well, a lot of people now have been switching to some of the other names like Sony Vegas, and what's the other one? There's quite a few. And then you have AI coming in. So the amount of pricing pressure that Adobe is going to be able to push going forward is not going to be as strong. But once again, if you just look at Adobe on like a growth level, their growth is slowed down significantly. So while Adobe may seem like, oh my God, this is a perfect company for a mean reversion play, if you look at Adobe's financials, but just their growth rate, let me just share it real quick. Okay, this is Adobe's growth rate. And let me do 12-month trailing so it's easier for everyone to kind of see. And let me get rid of this thing. They were growing in 2017 at 25% year over year. They had a bump up during COVID, but since then, the growth rate has slowed down to about 11%. Now, one of the things that Adobe is doing, and by the way, their forecasted growth is actually going to be going from 11 to now single digits to 8%. The question then becomes, what kind of multiple are you going to pay for a business like this? Now, one thing that they do have going for them is that they are buying back a crap ton of shares, which means that their EPS is absolutely going to be skyrocketing. So their EPS went from $1.26 back in 2015 to now almost $28 a share projected in 2028. So what is the fair price that you're going to pay for this? Well, for me, when I look at this and this industry, if I see a company growing only at 8%, even if they're doing massive amount of share buybacks, I'll probably pay about a 10, maybe 12.5 PE because I'm, trying to be conservative. If you're looking at a $28 or $29 EPS target by 2020, the end of 2028, right? So you have to look out into the future, right? So 28.78 times, let's say 12.5, you're looking at $359 a share. What's the current stock price of Adobe? 266. Am I really going to wait 3 years for a 30% return? That's a 10% return per year. And that's if you get a 12 multiple on this thing. That's if you get a 12.5 PE on it. If it's less, like let's say a 10, you're looking at about 28 times 10. So about 280, which is what it's trading at today. So you tell me, where's the juice in this? If now, on the other hand, if they pull a Palantir, and this is where learn from my mistakes, everyone. Learn from my mistakes. Palantir was in a similar boat where if you look at their growth rate, okay, and let's go back to when they IPO'd. And let me get rid of their EPS. Okay. You see this? This is when they IPO'd. Ever since then, they were coming down and they had gone to almost 16% year over year, 17, 18. Now, this is where I sold out of the company. Now, the problem and this is where I'll tell you, I made a mistake, is I did not believe that they could reaccelerate at this pace. When you end up reaccelerating at a pace like this, the market is going to absolutely give you a much, much better multiple. And it's going to give you a crazy multiple. And so that's why if you look at the stock, stock price, it actually followed that move. Look at that. I mean, until recently when you had this all SaaS BS happen, but look at that move up. Okay. So this is where you have to figure out, okay, what kind of growth does this company have and what kind of growth can it sustain? So right now, Palantir, it's inflecting higher. I don't know how much longer it's going to be able to keep inflecting, but as of right now, they're showing 55, 60% growth, which means that people are willing to pay an EBITDA of an insane amount. Let me see what it is. EV to EBITDA right here. I have to shrink this. So let me do actually on a forward basis because that'll probably give us a better forward EV to EBITDA right here. And hide this and hide that. In September, the forward EV to EBITDA was 174. Now it's down to 74. Okay. Where would I try to buy this thing? Probably at, like 50, maybe 60 EBITDA if it can maintain that. But once again, if at any point Palantir starts to go slower in terms of their total growth, then you've got yourself a re-rating in this company and this company's stock. The problem that Palantir is going to run into, in my opinion, is that they've gotten so big so fast. Every incremental add is going to be more and more difficult. It's just the law of big numbers, right? If you did $1 billion in revenue this year and then you did $2 billion in next year, you grew by 100%. If you grow by another, let's say $1 billion, that means that the next year you only grew by 50%, which is half. How does that make sense? Right? But it's literally the same nominal value that they went up by. But once again, the market's going to say, wait a second, you're only growing by 50%. Now, let's say the year after that, they did another $1 billion of growth. Okay. And the bigger you get, it's harder and harder. These guys, because of AIP, they really knocked it out the park. Like I think there's so many companies right now that they've switched to an FDE model because they see how successful Palantir has been at implementing their solutions using that. So, all right, I'll stop there.
So I built something out, and look, I agree to an extent. I do think that we're going to see consolidation. I think there'll be some SaaS companies that disappear, but then I think there's also SaaS companies that are undervalued, and the model will change from seat based to seat plus agent base. And when I look at the valuations, I mean, look, these are not my numbers, these are analyst numbers. I do have my own numbers on two of these companies because I am a shareholder of them. And I'll say which one, Salesforce and ServiceNow. That's the new one that I am now a shareholder of. And when I look at where Coca-Cola and Procter and Gamble trade, and I put those in for a very specific reason. I don't want to put Walmart and Costco because they have such high valuations. But both of these are under 20% growth over the next 2 years for EPS. They both traded over 20 times forward earnings. Salesforce is trading at under 13 times forward with 27% EPS growth over the next 2 years. Adobe is the one I'm a little iffy on because this is the one that I think could potentially get displaced. I just don't know enough about what they do. I'm not a graphic designer. I don't do anything on editing. The Premiere Suite may be fine and may not be in any danger. I just don't know enough about it. CrowdStrike technically would be considered a SaaS company. Even though the premium is high, I think that cybersecurity is going to rally hard. I'm loosely considering it. But Salesforce and ServiceNow look so inexpensive here. And when I look at where Benioff is saying that they're going to do, now keep in mind, they report in a week or two. But we got guidance out pretty far. I just got to find the slide. Give me 1 sec, everyone. Took me a while to find this. So this is from October. They gave guidance out to fiscal year 30. So they're saying that this fiscal year, they're going to do 41 billion in revenue, and that's going to grow to 60 billion in 2030. I mean, that's a lot of freaking growth. A lot of growth. You're talking about 45% growth right there. And they have one on free cash flow somewhere too. I think they said something like 15 or 16 billion free cash flow. Not sure what slide it is. But Salesforce is very interesting. Do I think that companies like ServiceNow and Salesforce is leaving? No. Companies are too dependent on them. Same with Workday and Oracle PeopleSoft. There's too much dependence on these companies for them to leave. I think that people are going to be very surprised at what happens with software. Did you see that Ives just added ServiceNow and Salesforce into the Ives AI 30?
I didn't see that, but I agree. Salesforce and ServiceNow. I think me and Steven, let me just give you guys some backgrounds real quick before I mean, well, I'm not going to go too in depth because I don't want y'all to find me where I work. But we work in industries that utilize these software products. Okay. Number one, we work in regulated industries, which means that we can't just buy off the shelf stuff. Everything has to go through a multi-year vetting process. It has to get through a bidding process. It has to go through all sorts of security checks to make sure that our organizations are not going to be vulnerable to attacks. The last thing any of these AI coding agents can do right now is create an application that's battle tested. ServiceNow, my organization has been using it for over 10 years. All of our data lives in ServiceNow. We are not getting rid of ServiceNow. The cost of ripping ServiceNow out and bringing something else on would be so immense. My organization would probably lose money for 2-3 years just to make up. Well, probably not 2-3 years, but they wouldn't be in a great financial place. just to replace these companies. That is how ingrained some of this stuff is. You've got every user in my organization. It took almost 5 years to get everyone trained on how to use this stuff. Okay. Including all the managers, including all the equipment that we have. Every single piece of equipment right now that we have everything is in ServiceNow. Every person that works in my organization has a ServiceNow login and an account and all this other stuff. Everything that we do is in ServiceNow. You cannot rip ServiceNow out like willy-nilly. Okay. This is not an Adobe subscription which you can cancel and sign up for another subscription to something else, download the application, and now you're ready to go. If you are an enterprise-facing software company, you cannot change in a heartbeat. Okay.
Not to mention, the last thing that the C-suite wants is to make a mistake on something like that, because that is an existential threat to the business. No CIO or CTO is going to recommend to the C-suite to get rid of one of these enterprise level products for something that Johnny B just coded with Claude. It's not happening.
Right. Especially at the big enterprise level. Now, could this mean that these guys possibly face more competition from up and coming startups that are like, hey, listen, we were able to successfully recreate a ServiceNow kind of replacement? Yeah. I mean, sure.
Yeah,
for like, let's say
companies
small
will
business.
probably do that.
Yeah. But these guys are not going to do that. Now, does that mean that ServiceNow is like a crazy value play right now? I don't think so. I think it's something that's more fair value to me right now. So that's why I'm not going hardcore into ServiceNow. I do think at some point we will understand if SaaS is really going to die, or whether or not this is just one of those opportunities that, you have to take. And I'll give you a couple of examples when we saw this. 2 years ago, everyone said, oh, AI, Google search is dead. Sell Google.
What happened there? 60 billion now. Where were we?
Remember Meta in 2022? Oh my God. No one's going to be on Meta. No one's going to be on Facebook. Oh, these guys are just burning in Reality Labs. Oh, they're dead. Oh, everyone's going to stop using Microsoft Windows. No one's going to use Office anymore. And I'm like, does Microsoft really justify a 25% haircut, considering that they have this massive partnership with OpenAI? They're growing their Azure business at all-time high RPOs. So like when you see that happening, there's definitely this worry that comes along. And I think sometimes the Twitterverse really puts like the demon out there and it mauls everyone. And this is where you kind of have to have enough courage in saying, what is this company going to do in this new era of Claude code and of Codex? How are they going to be able to get around it? Now, do I think some companies are not going to be able to get around it? Probably. But companies like ServiceNow, I'm not, let's just say I'm not worried, but I will say this. I'm not liberal enough to assume that this is the bottom. I am a conservative investor during this period of time. Like, I think the market is really overvalued. So unless I see a deal that's like an absolute steal, I'm not like super heavy going into it. I think ServiceNow is going to be fine long-term, especially if your time horizon is there. And remember, all of this is a bet. Okay. No matter what anyone tells you, oh my God, I think the growth of this company is going to be X, Y, and Z 2 years from now, bro. That's all of this stuff. We're just estimating. Everything is a risk. Everything is a gamble. But I'll tell you one thing. If it's at a high valuation already, that means that the risk that you're taking, that valuation comes down, is way more than if the valuation's down here and now it just has to kind of stay where it is today or even grow up slightly, and you'll get a tremendous amount of return. So I think ServiceNow could possibly be at fair value right now. It's not undervalued. I think it's fair value. If it dips another 20%, probably gets into more value territory. It drops another 30%, you're looking at deep value territory. But I don't know if it'll ever get there. And that's the bet that I'm making. If Steven says, hey, I think this is the bottom, he gets in at this price, that's his judgment. Me, I still think there's probably some room to go. I
didn't catch the bottom. I didn't know where it was going, and I wanted to start a position just in case. If it goes to 90 or 95, I'll buy more. I'm more interested in Salesforce now because they guided for 14 billion. Free cash flow in 26. We'll see if they up it or keep it the same when they report in a week or two. But the reality is that they will more than triple their free cash flow over a 5-year period. And this company is selling off so much. And the amount of capital they're returning, especially in buybacks, 80% of free cash flow going to buybacks. I mean, that's crazy. I'm telling you, there's so much people don't understand about Salesforce. People think it's not an AI company. It is an AI company. Agentforce and Data 360, the numbers keep getting better on it. And I just think so many people have an opinion that it's a bad product, but their opinion is just that, an opinion. And their opinion is not changing their organization, using it or writing a check to Salesforce. And I just think Salesforce is one of the ones that has real staying power. And it's like PayPal. The numbers are just too good for the valuation it's at. This is now under a $200 billion company. You're paying roughly 13, 14 times free cash flow. It's insane.
Yeah. Someone was asking about Uber. Just be careful of so there are companies out there that they could be value traps. Okay, I'm not saying Uber is a value trap, by the way. I'm just saying there could be value traps. Like if you told me, hey, Chris, guess what? I got this great deal on typewriters. The company is 95% off. Do you think that I would buy that company, even if it's trading at a huge discount? Like, no, there are industries that if they're going to be disrupted, just don't try to be in them. Don't try to figure that out. So I would say Uber, in my opinion, and I don't know if you can agree with this or not, Stephen, I think Uber's days are numbered. I think Uber in about 10 years from now, no one's even going to remember what Uber was. I think everyone's going to be in autonomous taxis and all that stuff. I think every review that I've heard about Waymo.
Why wouldn't Waymo and Tesla FSD be on the Uber platform?
Why would I want to give up margin? You tell me. I'm Elon Musk. I'm saying I'm going to give 20% of my profit to Uber for what? For an app? For access to an app? I can't design I'm Elon Musk. I can't design an app for my own thing and save myself 20% margin on every transaction. You think I'm Sundar? I'm like, yeah, let me just give away 20% of my money to Waymo. I mean, to Uber, so that
Elon should just buy Uber for the platform and get all the customers.
I mean, that's a possibility, but
because think about it. Am I really downloading another app? No. I'm using Uber because I'm lazy.
I think this is, but that's the thing, dude. Lazy. If you're telling me the price difference between, I'm lazy too, but if I see a $10 price difference between an autonomous vehicle and this one, I'm going to go to that $10 list.
No, but that's my thing. I'm not sold on the idea that there will be no autonomous vehicles on the Uber platform. And
dude,
if that's true, which it may or may not be, but if it's true, that would mean that you don't need to download another app and just waste 2 minutes. And it's just one less thing I have to do.
Sorry, dude. I'm telling you right now, I think if it's just an app download away to save money on it, most people just download the app. If anything, I'm sure Waymo and Tesla and all of these guys are already working on something. I mean, they already have it. They have their own apps. Like I said, there is no moat in, users are going to click 2 buttons less. And not to mention, once you get into it, these guys could do loyalty discounts. Like Tesla, you think Tesla's not going to do ride 9 times for free? I mean, ride 9 times, you get the 10th ride for free. Or Google's not going to say hey, we're going to give you a loyalty bonus if you choose us, or there's going to be a higher tier version. Dude, everyone is going to try to do everything they can to retain customers and retain margins.
You think Tesla's a buy here?
I don't know, man. I've never been good at evaluating Tesla because Tesla never trades on any fundamentals. They all trade on what Elon the bullishness of Elon is what Tesla trades on. So that's why Chanos has always gotten Tesla wrong. That's his biggest albatross, where he's tried to value Tesla like a investor, not knowing that 80% of Tesla is probably retail investors who don't give a shit about earnings. They don't give a crap. They care about what Elon can basically bring to the table in the future. And Elon is very good at it. He understands it. Oh, EV revenue is slowing down. Profitability is going down. Don't worry, guys. I got robots coming next year. Oh, the robots aren't enough. Oh, I got space data centers coming next.
Can I show you something? And look, I love Elon. I think Tesla is an amazing company. It's going to do amazing things in the future. The thing that scares me, when you actually look at the Mag 7 together, Tesla needs to 20x its operating income to generate the same operating income as Meta. 20x.
I'm sorry. Let me respond to one comment. Someone said Waymo and Tesla have technology. Uber has the users. Did you know that Netscape had all the users right before Chrome came out?
That can change very quickly, everyone. Look at AOL. AOL had every user.
Every user in the country was on AOL at one point.
They sent you a CD in every other freaking magazine.
Yep. And Bill Ackman also owned a lot of Valiant Pharmaceuticals. I know because I lost money with him. So just because Bill Ackman's got shares doesn't mean you should hold them too. A lot of these guys, they have their own blind spots.
So and this is where I get a lot of things wrong. And I'll admit I get things wrong looking at it because it's just not the way the market works. But when you look at Meta and Tesla has to 10x I should move this down to. It has to 10x the freaking EBITDA to get to where Meta's trading. Now, let's say Elon does that over the next decade. Hypothetically, Tesla's going to be at some crazy number, but Meta's EBITDA is certainly not going to be here. My argument is, why should Tesla get the benefit of so much expansion when Meta's already there? Like, I don't think Tesla's 10x in the EBITDA anytime soon. I don't think that they're 10x in cash flow from operations anytime soon. I think this valuation is bullshit, my opinion. The profitability is not there. Like, what do they have to do with Robotaxi and Optimus to get anywhere near what Meta's doing? And that's why Tesla scares the shit out of me, and I always get it wrong. Because for how big of a company it is, it has no reason to trade here. Zero.
I'm in agreement with you, bro.
And I get that's not the way the markets work, but there's only 8 or 9 companies that are over $1 trillion market cap. Meta is the closest.
Hold on. Why don't you do the same thing and put Palantir right next to them?
You really want to piss people off, don't you? Sure, Chris. We can do that. No problem, Chris. No problem. Una momenta. Good old Palantir, which, in all fairness, had one of the best quarters, if not the best quarter operationally I've ever freaking seen. Craziness. I'm surprised you're not laughing at.
I'm laughing inside.
There you go. You're laughing on the inside. It hurts me to do these freaking numbers.
So tell me, what does Palantir need to grow at to get to Meta's level?
Oh, dude. I'll put Salesforce on the other side of this. Give me a sec.
Yeah, but see, the difference is Palantir's growth rate is freaking phenomenal. So eventually they could get to that level. I just think that the market is like front running that success story. You know?
I agree with it. Yeah, I'm sorry. Palantir's margins, everything about Palantir is amazing. Okay, but gross profit margins better.
Steven, better? More than likely next year, Palantir is going to generate more net income than Tesla will.
Yeah, it will. I mean, Meta's got a better EBITDA and operating margin than Palantir, just so everybody's aware.
Yeah. Yeah, but look at that free cash flow margin on Palantir, bro. You got to give it to the
Amazing.
cart, bro. They are not hiring anybody. They're like, nah, we're even going to reduce our staffing. Have you heard of a company growing at 100% saying, fuck it, we're going to lay people off?
Palantir's going to do 7.5, 8 billion revenue next year.
It's pretty insane.
At these margins, I mean, look, is Palantir expensive? Yes. The difference is in 5 years from now, this valuation may not look expensive. This could be a $500 billion company in 5 years, maybe 600 billion. Like, the sky's the limit. We need to see this time next year what they're going to guide for in 2027. Because 2026 is going to be phenomenal for Palantir. But still, we look at Tesla. Tesla needs to do so much to get anywhere near Meta on profitability that I'm sorry, I'm not seeing it. Tesla should be but when you look at Tesla versus Palantir, I mean, look, Tesla should be a $400 or $500 billion company.
That's about right. I agree with that.
I mean,
but then the robots, bro.
But the robots. I mean, Tesla's a 4%. This is like freaking Walmart, a 4% net income margin. 4%.
Palantir does do share buybacks, but they don't do enough share buybacks to not be dilutive to shareholders. And as a shareholder of Palantir, you should not be.
You do not want them to buy shares here.
Right, because they're going to be overpaying and they destroy value for shareholders. You do not buy your shares back when you're trading at this kind of multiple.
No. I am still a shareholder of Palantir, and I do not want them doing buybacks there by any means. Yeah. Keep that cash on the balance sheet. Let it generate interest, even though the risk-free rate of return's going down. Shares are too expensive. If anything, issue more fucking shares here at these prices, at these levels, pad the cash, and then if the stock just happens to go down, then start buying it back.
This is where you can support the share price.
Buying back.
Yeah, because eventually Palantir's growth will naturally slow down, and when that happens, you're going to get a re-rating of the company. So that's when you want to buy back shares heavily to kind of support the stock price. And this way, it also keeps the short sellers, also keeps a lot of activists. Well, technically, Palantir doesn't have to worry about activists because they have their founder structure, but they do have to worry about short sellers. So,
but I mean, Palantir is a company that it's pretty hard to get confident on a short position when they're going to grow at 70%. I mean, their growth is accelerating. They have 139% net dollar retention. They did around 700 deals of $1 million or more this year. Operationally, it's one of the best companies I've ever seen. And Tesla has shown that companies don't have to trade on fundamentals. And Palantir for the next couple of years doesn't have to. And in all seriousness, I think Palantir is going to grow into the valuation. I really do. And I think at some point it's going to be a much bigger company.
Yeah, but I mean, Joe, if you buy it now and it grows into its valuation, I'm not about to sit here.
No, you wanted to buy it when we were buying it at $7 to $12.
Right, exactly.
Like,
I mean, I don't expect to ever look. I don't ever expect Palantir to get back to $7, $8. Okay, like that train has sailed. Even $20.
I think 100 has sailed at this point.
20? No, I don't think so. I think it could definitely get down to like below 100. I think it could get down to minimum. No, maximum. I think maximum is 50. Minimum, I think it could retrace to 75.
I was saying 60 was where it could retrace to before earnings. Now I'm saying I think it's going to be hard to get past 100. Does it deserve to go down on evaluation? Probably. But damn, that quarter was amazing.
Yeah, it was pretty good, man. I can't deny it either. It's just
that quarter
like
was
you
amazing.
said, it'll grow into its valuation. So if there is a general market sell-off and somehow this name gets sold off and gets back down to like the 70s and even maybe like 60s, I'll be a buyer again. I don't mind it. You know, I just don't want to pay this price right now. I'm cheap. I want a discount.
Yeah, I mean, look, it's a great company. Great companies deserve a premium. Does it deserve that type of premium? I don't know. But Tesla scares the hell out of me here. Really does. And there's so much value.
Yeah.
I look at Amazon, I look at Alphabet, even though it's run, it's really not that expensive. I mean, the only one that has not reported yet is freaking Nvidia. And you have Microsoft, Amazon, Nvidia, and Meta all trading under 20 times forward.
Yeah.
I mean, look at this real quick. I mean, when have we ever seen these companies, these four together, this cheap? I
Never.
haven't. I can't remember
kinda,
a single time.
No, I've seen them. No, 2022, Meta was trading at an 8. It's like a 6 forward PE. That was insane to see that.
Okay.
But then again, Meta was also decelerating their earnings as well.
I don't
they
know that we can
decided to go
count
higher.
2022. The NASDAQ went down 30%, 40%.
No, I'm just saying you have to
Okay.
take that into consideration, right? If
Sure.
there's a general market
in the past
correction,
couple of years, we have not seen it this inexpensive.
yeah.
I mean, Microsoft, the 18.5 times is incredible to me. That's why I bought more last week.
You want to know something funny? This is where Google was trading last year too.
Telling
Google
you,
was
Microsoft is a $550 or $600 stock.
And remember, you're looking at 2028. That's why I was wondering. I was like, wait a second. Next year is going to be 17.
Yeah.
Like
Current year, next year, following year. Yeah. I want to show you one other thing. I want to put Apple and Microsoft together. Look at this craziness. So for people who don't think that Microsoft is undervalued, check this out. Microsoft is $1 trillion less market cap than Apple. It does less revenue. It does more gross profit, more EBITDA, more operating income, more cash from operations. Free cash flow is less because they spend 6x more on fucking capex, but they do more profitability.
Yeah,
and their also margins are better.
And what's better is Microsoft is actually growing. If you look at Apple's growth rate, top line, it's barely flat. It's basically flat for the last 5 years.
Like
when you compare that to
numbers, tell me how Microsoft deserves to be a $3 trillion company if Apple's $4 trillion.
Well, that's because of uncertainty. You know, people are worried that
people are worried about what OpenAI. It's the most ridiculous thing.
No, everyone's worried that basically Microsoft is throwing all this money at what is it called, at the capex buildout, whereas Apple is just doing what? A bunch of share buybacks. You know, so there's kind of
have we not seen what Microsoft's grown their profitability into? I mean, the EBITDA alone has grown over the past 5 years from 2021, 80 billion. They've more than doubled the EBITDA in 5 years.
Yeah.
Because of deploying capex. Microsoft to me is the easy for me. Okay, don't follow me on this. But for me, it's the easiest buy right now in the Mag 7 is the last thing I bought. I bought some last week. The numbers just make sense.
I mean, we could take a look right here. Let me just share my screen. Okay. And let's take Alphabet, Meta, Apple, and Amazon. So Microsoft is trading at a 14 forward EV to EBITDA. This is all the way back in freaking 2019 is when they were trading at that. And they were leveled out at that time. And they weren't, I don't think they were growing that much either. Let me just do revenue. Income statement, revenues. I just want to see the growth rate in revenues. Where can I? Percentage change. Yeah. So look at this. The revenue growth on Microsoft is like 16% year over year. Back then, it was like 14. So 14, it kind of stayed there. Growth rate accelerated to 20, came down to 6 in 22 and 23. went back to 16, came to 4. So it's within range. Its growth is kind of, it should be trading at a higher multiple for sure. And it's got a buyback yield and a much higher dividend too. So
I mean,
I'm in agreement with you. I think this shouldn't be at 14 on a forward. That's really low.
they got 90 billion in cash on hand.
Yeah.
They have another 21 billion in long term. On a buyback standpoint, they repurchased $22 billion worth of shares, and they've paid out 25 billion in dividends over the past 12 months. They're returning capital.
Yeah.
They're growing. They're investing for the future. And the reality is nobody can compete with them on many things.
Look at this. This is how bad Google was being dogged.
Yeah.
Google was trading at a 10
Google.
forward. Yeah. Yeah. Look at this. Google got dogged for at least like 2 years. Well, that entire narrative, search is dead, Google is dead, all that shit, just everyone was just letting it die. And then all of a sudden that whole thing got resolved. They launched Gemini 3 and this thing came back roaring. And it's the same thing like Apple right now. Apple is still expensive. Look at this. Apple in the past used to trade at like 6. Now it's almost 24. Apple is getting its premium from its steady growth. And then where was it? Meta. Yeah. Look at this. This was the time for Meta. Meta on a forward basis on EV to EBITDA was 4.5. That's when the stock price was $88 a share. But then it just roared higher because their growth started to absolutely go insane at the same time. Let me just get rid of Google. Sorry. Apple, Amazon, Microsoft. This. Okay. Yeah. So you see this? How their growth kind of flatlined and then all of a sudden started to increase again? This thing got re-rated. Now Meta's like kind of steady. It's a steady eddy. Huh. Interesting.
Yeah. I mean, look, I am a believer in Microsoft here. It's going down on the wrong reasons. What do I know? I just do a lot of research.
Let me get rid of Meta. Yeah, this. Let's see. Yeah, this. You see, this is a wild disconnect. Revenue is going up, but EV to EBITDA is going down. This is like a perfect setup for a fundamental recovery. I wonder what Satya's going to do.
Would people really be surprised if Microsoft goes to 550 or 600? That's the other thing. No, nobody would be surprised.
I think Amit started buying Microsoft, which kind of shocked me because Amit usually is more of a like story investor rather than a fundamentals guy. You know, but I think he's maturing.
Listen, intelligent cloud growing at freaking 39%.
Yeah. Yeah, if you look at the KPIs on this, it's insane. I might have to actually buy some Microsoft, man. I didn't realize how undervalued it was.
I'm telling you, it is so undervalued.
Let me see. Yeah, their growth is going to be 17-ish. They can maintain that pretty well. And let me do. I'll have to do some numbers. I'll do some digging. But there's segments right here. Intelligent cloud is growing the fastest. Productivity, personal computing revenue, total revenue change. Yeah, revenue is about flat. It's fine. What kind of margins? Azure right here. Where's the RPO? Remaining performance obligation right here. So this is the crazy thing to see, guys. Remaining performance obligations is like how much like future customer demand they've already booked out. They literally went, and this is on a TTM basis, okay? Actually, this is annual basis. Let me do TTM.
People are worried because it shot up so much, because it doubled because of OpenAI. I don't think that's a reason to worry.
They have $600 billion in backlog. It's crazy. Jesus Christ.
And people are selling. Think about how screwed up this market is. People are selling this company, even if that backlog was 300, not 600 and whatever. It is still a steal here.
You're telling me that they're probably going to double up on their revenue eventually?
Yeah.
Huh. Look at that disconnect, man. That's insane. That means they grew their RPO by a lot.
We're seeing a rotation out of hyperscalers for the wrong reasons.
Yeah, man. I would be shocked if this growth didn't accelerate more, man. I think that the growth that these guys are projecting is what, like from 14 to 17 with that kind of RPO?
Did you actually go through their press release yet, Chris?
I have not. I've never been a really Microsoft guy, but I did see their RPO number, which shocked me. But I was like, I didn't take the time to look at like how far out their RPO goes. The other thing is this got me bullish on NVIDIA because Microsoft.
It's so bullish NVIDIA.
Because if they see this kind of future demand, Microsoft is going to just go out there, buy a crap ton of NVIDIA GPUs, and to meet the demand, I mean, clearly you can see.
I want you to read something. Okay.
Okay.
Okay. Business highlights. Microsoft Cloud revenue up 26%. 365 commercial cloud revenue increased 17%. Consumer cloud revenue 29%. LinkedIn revenue up 11%. Dynamics 365 up 19% means that they are taking market share in EPR land. Revenue in Intelligent Cloud was $32.9 billion, increasing 29%. Azure and other cloud services revenue increased 39%. This was one of the numbers that took them down because the street wanted a 4 handle on it. They wanted 40%, and this is one of the reasons they took Microsoft down. This is also an incredible report that is showing how much they're monetizing their assets. This stock does not deserve to be down where it is.
Yeah, I think it's oversold, but whatever.
Yeah, we got things on the list to buy. Microsoft, I'm still buying, and I'm probably got to start positioning PayPal because PayPal looks very undervalued.
Okay, I think we can end it here. Sorry, guys. Eventually, me and Steve have to go back to living our life again. But yeah, the point is, there's actually some good discounts on the menu this year, which is nice because going into this year, bro, I was like, man, there's nothing to buy. Like everything sucks. Everything that I understand anyway, that sucks. So I'm long Amazon. I'm long PayPal, of course, because of this options play that I have. Long Verizon because of options. Google. I have a ton of spreads that have done crazy well. You know. Chris, what are your thoughts on SoFi bull call spreads? I don't know about SoFi enough to do it. Sorry. Like, that's something you ask Tanner and Tevis and all the SoFi guys, not me. Yeah. The only thing that I would say is a challenge, though, Steven, is if there is any sort of, you know what? I don't see it. If Google today came out with that $15 billion like bond raise and they weren't oversubscribed to the level that they were oversubscribed, I think that could actually cause the market to crash. But the sheer amount of demand that Google had for those bonds is amazing. And I think that's why Oracle ran today. because that shows that there's actually investor appetite to invest in the data center capex build from the bond guys. And I don't chat, don't get mad at me for saying this, but bond guys are 10 times as intelligent as equity investors.
Dude, how about the fact that companies like Blue Owl, maybe not Ares to that extent, but definitely Blue Owl, maybe some of the other ones, are cannibalizing themselves by investing in freaking data centers because of all the small SaaS companies they've invested in? They're basically counterintuitive. It's insane.
Yeah.
Because they have to go mark to market, and they're invested in all the small SaaS companies because they're lower middle market companies.
Bro, every endowment I know is loading up on this. Dude, you're talking about a AA rated company that's going to give you what is it, almost a 600? Like what was the yield on the thing? 5.5, 6 almost? I think it was 100 basis point over. On Google's bonds, the 40-year bonds, 50, I think 40-year or 100-year bonds. Like there were a whole bunch of tranches. There were a bunch of tranches that were out there. I was like shocked at the rate that they were able to borrow, but it was oversubscribed, which is a good sign. That means that there's actually appetite.
The next one I'm doing work on is Oracle. It bounced a little. I think we have found a bottom. I'm a little worried about the upcoming earnings report. That's why I'm not doing anything until that earnings report. But Oracle's looking interesting. So once the new report comes out, I'm going to do some more work on it.
I agree. Oracle's worth looking at, but I'm not nearly as bullish on Oracle as I am on Amazon. I think Amazon is very, very undervalued relative to where they could be. Azure reacceleration is going to be a very, very value accretive thing for multiple expansion for these guys. And they're trading at all-time low multiples. So I think this easily gets to about 12, 13, maybe even 15 on a forward basis, which means that Amazon goes from, 210 right now to like 300 probably by the end of the year, which is where all the investment banks have hit their targets anyway. You know, the only challenge that Amazon is going to have is that people are looking at Amazon and they just can't comprehend that $200 billion capex spend. It's the same thing with all the other hyperscalers. They just can't comprehend it, man. It's interesting. If these guys did not have that level of demand, I don't think that they would have spent the money.
They have, exactly. Very well said. Because they do have the demand.
Yeah.
I mean,
and then on top of it, you also have what is that called? NVIDIA. Like you heard what Jensen was saying when he was talking to Gertzner?
Yep.
Gertzner was saying that, like, let's play that clip real quick because I think that's a very important clip for people to understand.
So look at the freaking capex growth year over year. Look at that. This is going to be insane for NVIDIA. And look, Jensen said next 10 years, this infrastructure build that's going to happen over the next 10 years. And the reality is that these companies have grown. Where's the stat? I don't feel like going through this whole thing again, but you can read I go through everything. The investment in CapEx has allowed these companies to expand their cash from operations by so much that if they weren't doing this, they would not have these levels of profitability. So
let's watch this one clip. Let me just make sure. Let me make sure the audio is on so everyone can hear. Okay, it is on. Okay, there we go.
Can't hear it.
Oh. Let me close this. Share screen, window. This also share audio. Done and got it. And now you should be able to hear it.
Yep.
It's an interesting time to have you, obviously, which any time is, but especially given what's been happening within the market. Today looks a lot different than the last couple of days have. The market obviously concerned with what's happening on the spending side. of the hyperscalers and this big build out in AI. What's your take from that, the way the market continues to react to this?
Demand is sky high, and there's a fundamental reason for that. We're in the once in a generation infrastructure build.
So, before anything, do you think he would be coming out and saying this right now before earnings if he wasn't going to say the same exact thing during earnings?
He has the numbers to back it up on earnings. How about that?
Probably, yeah.
I mean, how does he not have the numbers to back it up? Think about it. These companies just came off record years of capex and just signaled that it's going to be freaking gas flow central in 26. 200 billion from Amazon, 180 billion from Alphabet, 165 from Meta. And then when Microsoft ends their fiscal year in June, guess what happens in July when they report? Oh, they have to come over the fucking top now. Like this is not stopping.
This is 3 days ago. Okay, so just keep in mind.
This is the largest infrastructure build out in human history, and there's a fundamental reason for that. Artificial intelligence is going to fundamentally change how we compute everything. Everything from database processing, the way we do search, the way we do recommender systems, the way you watch movies, and of course, these new agentic systems that are being developed and evolved. This last year, we saw an inflection point in AI. AI became super useful. No longer hallucinating, it's generating informed content, it's reasoning, it's thinking, it's doing research, it's able to use tools. All of a sudden, AI over the last couple of years went from being curious to super useful. The inflection point also came with it, profitable tokens. Anthropic is making great money. OpenAI is making great money. If they could have twice as much compute, the revenues would go up 4 times as much. I mean, literally, these guys are so compute constrained, and the demand is so incredibly great. The number of enterprise users, the number of consumer users, the number of startups that are being built on top of these companies, it's just going through the roof.
So when you see numbers that are frankly remarkable, that $660 billion this year will be spent by the hyperscalers as we continue to learn, like we did from Amazon last night. You sit back and think to yourself, that's completely justified based on what you see?
It is appropriate and sustainable. And the reason for that is because all of these companies' cash flows are going to start rising. You know, people are comparing it to cash flows. One of those numbers are wrong. It's just the cash flows are wrong. We are addressing the largest software opportunity in history. For the very first time, software is not just a tool. A tool is like Excel. Now software uses tools. So these AIs use Excel. And so I think the opportunity for this new era of software is incredible. And we're seeing it already moving the earnings of Meta. Nobody uses AI better than Meta. And so if you look at the way that they're using AI went from a classical recommender system running on CPUs to now a generative AI agentic system that is making recommendations. Everything from the way social media works and the way they recommend ads and help advertisers create content has fundamentally been changed. And their earnings show it. And that's the reason why they're investing so hard. They see just a much larger future potential for it. And not just one company. This is going to affect AWS's shopping and the way they recommend goods. This is going to affect how Microsoft's enterprise software works. Every single company sees the same inflection point, and that's why everybody's leaning in so hard.
I feel like that's the point that it's an interesting point. It sort of turns the way you need to think about these businesses on its head. That if you're just fixated on the spending side, as you were talking earlier about, oh, they're spending such a huge portion of their free cash flow, you're kind of missing the story. The market needs to get its arms around that. Do you as well as an investor?
Yes. If you turn the clock back, Scott, to 2008, 2009, right? Amazon could have taken their profits and sent them back to us by way of dividends. Instead, Jeff Bezos said, I'm going to invest in this thing called AWS. Think of it as digging a gold mine. You have to spend a lot of money to dig the gold mine before you get the gold out. These guys are digging the biggest gold mine in the history of software, right? But it costs something up front. Now, the question is, do you believe Andy Jassy and Mark Zuckerberg and Sundar and Jensen that this opportunity is that big? Or do you have a special insight that causes you to understand there's gold in the bottom of the gold mine? As an investor, I'll just tell you.
Yeah. What have I been saying for the past several months. I've been putting it on X, been saying it in the videos. Chris has been saying it also. Are we really going to sit here and listen to the bears that have missed pretty much every technical revolution ever? Are we going to listen to these bears and these analysts that don't believe in the AI revolution, that don't work at these companies, have never built a company that's $1 trillion, have never managed balance sheets like this, and have no stake in how these companies allocate capital? I'm going to listen to Zuck, Sundar, Nadella, and Jassy over any of the short reports, any of the bears, because they're the ones that are dictating how AI is going to be utilized in our lives. Gerstner said it perfectly.
There's one part of this that I'm not going to spoil, but this is the part that gets me bullish on this.
Yeah.
You this. I want my personal net worth. I want my fund's net worth levered against AI, because all human progress is going to be derived from machines helping humans think and augment human thinking. And so whether it's owning NVIDIA, which is our largest public position, or whether it's Anthropic or OpenAI, all of these companies are going to be tremendous beneficiaries, and they're doing it at scale. There are increasing advantages to scale, right? And so I think it's hard for people to get their arms around now, just like it was in 2008 and 2009. But thank God Jeff Bezos did that. Now it's a $140 billion business generating $30 billion a year in annual profits that people criticized him for investing in back then.
How can
It's incredible that OpenAI and Anthropic are $20 billion run rate companies, generating profitable revenues and accelerating growth all at the same time.
Right.
These are extraordinary things, and it makes perfect sense from where we sit.
how can we be so certain that the amount of compute we think we'll need and that we continue to hear from CEOs like you that we will need is actually going to come to fruition? Isn't it inevitable that we're going to, at some point, overdo it, but we're not going to know that until it's too late?
It's not like roads. Roads, once you lay it down, it stays fairly useful for a long time. The way computers work is you build up the infrastructure, but then you start replacing it 5, 6, 7 years later. And so I think it's going to take us some 7 years, 8 years to build up to the level that we have to sustain. And after that, we're going to be refreshing and slightly growing. And so we've got several years of build out ahead of us. The important thing is this: you have to go back to first principles. Computing has fundamentally changed. It used to be pre-recorded. Excel and PowerPoint and all these tools and all the software is pre-compiled. They compiled it and they send it to us. The way software works now, because it's contextually aware, every single time you use it, it takes into consideration the context, who you are, what you're asking about, what's happening to the world, what other information you give it, the context. And every single context is different and every single response is different. So from now on, every single pixel, every single beep of a sound, every video that comes out of the computer is generated in real time. And that's the reason why we need computers to operate software at such a large scale going forward. And all these tokens are what we call intelligence. And for the first time, we're generating something of tremendous value, intelligence as numbers. And these things, as I mentioned earlier, this last year, we went through an inflection point because these tokens became profitable. And so we just have to make more of it.
Can you blame, in some ways, investors who have PTSD from the last time tech went through this revolution and evolution at the same time for seeing certain things that remind them of then and worry that they'll happen again?
It's good to always reflect on history. History informs us, but history doesn't repeat. And so you have to take into consideration what's actually happening. Always go back to first principles and think about what is actually happening. Right now, the fundamental difference, a huge difference between now and some things that happened in the past with the internet, there was a ton of dark fiber. There are no dark GPUs. 100% of the GPUs are rented. In fact, GPUs that we sold 6 years ago, the prices are going up. It's not like it's antique. I mean, it's incredible. It's like a fine wine. The demand is so high that GPUs I sold 6 years ago are going up in price. And so I think the demand is just incredibly high for the reasons that I just said. One, we went through
This part that's coming up, Steven, I don't know. Did you listen to this thing?
Yeah.
Okay. This is the most, like, in the chat, everyone, this is the most important part.
inflection point, AI has become useful and very, very capable. 2, the adoption of it is incredibly high. And 3, because these AIs are thinking, the amount of computation it needs is great. And so to the extent that people continue to pay for the AI with, and the AI companies are able to generate a profit from that, they're going to keep on doubling.
Ah, that part didn't come across. What happened?
The interview is 22 minutes long. They only have the 8-minute clip on CNBC.
Where is that? Damn. Oh, well then, this is
The Super Bowl
one.
here is the reason why people adopt 0.3 codex, another inflection. We want to
Like them to be bigger customers than they are now.
To accelerate the American AI stack around the world,
This part.
Should we
I think it was
sell
around
chips to the Chinese because they
right here.
there's a lot of money that wants to invest strategic.
Okay, right here.
Everybody's going to be everywhere, right? These guys are going to, have OpenAI models. They're going to have Anthropic models. They're going to have DeepSeek models running on, on their chips. And I think when you look at this next round of funding, right, NVIDIA and Microsoft just invested in Anthropic, right? OpenAI probably is going to get investment. There's a lot of rumors out there from Amazon or others. Like, none of that should surprise anybody. If you want to be in the game of AI, these are the 2 frontier labs in America, 2 leading labs. Put X.AI in there as well. It's going to be fascinating what they do with Starlink and data centers in space. And you're also
I'm a big investor.
You're also a big
in
investor
XAI.
and partner
Yeah.
and partners there. So I think you should expect that as the new normal. And, we like to make a lot out of these things because, of course, they're competing. Everybody's competing to make sure they're the lead in those investments. But I think here's the thing that I think it tells you. Everybody had this idea the last couple of months, OpenAI's dead and Anthropic to the moon, right? OpenAI just launched another incredible model yesterday with Codex. They're going to raise a lot of money. I can tell you there's a lot of money that wants to invest, strategic money, financial money, et cetera. And the good news for your viewers is both these companies are going to be public over the course of the next 12 to 18 months in retail investment.
I can't believe he actually said that, because they are going to do that. Because I don't know if they actually released their S1 yet. But dude, as long as there is anticipation of an IPO of both OpenAI and Anthropic, in my opinion, this bull rally goes on in the AI space. Maybe once they IPO, maybe there could be some drawdowns, but until then, bro, let the market run. Let it do its thing. SpaceX is going to IPO this year too. I mean, usually when these IPOs start coming out, Steven, that's usually a sign that the top is here. You know what I mean?
Yeah, but these numbers are too strong, and these freaking hyperscalers have the profitability to scale the capex.
Yeah.
All roads lead back to NVIDIA once again. They all do.
By the way, everyone. So Brad Gertzner, he's a hedge fund manager for Altimeter Capital. He cut his teeth in the 2008 crisis when basically everything had sold off. He went out, he borrowed money from friends, family, anyone he could, and he bought I think a bunch of tech stocks, and he just killed it over the last he's a really good investor. So in terms of technology, he's usually, let me see, Altimeter Capital total. Okay, let's see. Yeah, it's the past 3 years. I wish I could actually see past however many years. Yeah, Altimeter funded right here. It was launched with less than $3 million of Gerstner's friends and families in the 2008 financial crisis. Prior to that, Gerstner worked at PR Capital Management. And now I think that assets under management are how many billions? 6.7 billion in AUM. Oh, wait. Actually, it's more. Yeah, if there's anyone you want to bottom feed off of, portfolios that you want to bottom feed on, it's this guy right here. Let's see. See all holdings. So the number one position that they have is NVIDIA. Number 2 is Meta, Microsoft, Snowflake, Uber, Amazon, Hood, Coupang, TSM, Broadcom, PDD, Baba. He increased a lot of PDD Q3 of 25. Let's see. What did they add? Gemini Space Station? What? Google. He added Google again after selling it off. PDD. All right. Sold out of Confluent, Snowflake. All right, whatever. All right, Steven, now we really do have to go.
Yeah, I got to get going. Thank you, everybody, for joining. Really appreciate it. We'll be back next week.
Yeah. Tomorrow is Fiserv earnings. Let's go, Fiserv. Hopefully they guide higher. We'll see how their turnaround is going. So we'll see what happens.
All right, everyone. Enjoy
Have
the
a good
rest
one.
of the night. Talk to everyone later.
Take care.